Well, thank you very much, and we had a great time working together at the Bank of Canada, so good to be working together again. I'm going to start a bit like where Jerry started, the future of banking. It's a big topic, too big for me. So I'm going to focus on three areas that I think are going to be important to shaping banking in the future. And the first one is the same as Jerry's. Regulation, and then I'm going to focus on, let's see if this works. Oh, regulation, yep, good. Culture and technology. And I'm not sure I'm going to be able to separate my various hats. So I know you want me to speak from my perspective as a board member, and that will be part of it, but I think you'll see I'm going to sort of use my four-legged perch as a former central banker, former regulator, chair of a risk institute, and board member of Scotiabank, and of course, dean of the Rotman School. So I'm going to start with regulation, and the message here is that the sweeping regulatory changes we've seen in the wake of the financial crisis have had profound effects on the business models. And it's fair to say that this has dominated the attention spans of both management and boards at banks for most of the last decade. But looking ahead, my message is that similar to Jerry, I would agree, we probably have not reached peak regulation, but I think we probably are getting close. And I think over the next decade, regulation is probably not going to be the dominant theme that it was over the last decade. So what is going to be more important? And my sense is that the most successful banks will be the banks that get two things right: culture and technology. Culture speaks to integrity, it speaks to customer focus, it speaks to a risk mindset. The reality is, in a bank, these are everybody's business. Integrity, the customer, risk management, that is the business. Disruptive technology is touching every aspect of financial services. Payments, e-money, e-payments, cryptocurrencies, lending, you've got peer-to-peer, you've got crowdfunding, asset management, algo trading, robo-advisors, insurance, wearables, sensors. You're also seeing innovations that span the gamut from relatively simple apps that are designed to delight customers to potentially more revolutionary innovations, artificial intelligence, quantum computing, general ledger or blockchain technologies. Successful banks are going to be the ones that embrace this technology to delight customers, to create new markets, and to drive both efficiency and performance. And this is going to require new skills, but it's also going to require new behaviors. Technology is as much about people as it is about hardware and software. And so that brings us back to culture. In the future, openness to change, agility, adaptability, resilience, these are going to be more important attributes of the employees of successful banks. And the real challenge is going to be balancing, on the one hand, the need for speed, risk-taking, agility, with a culture of integrity, a consumer focus, a risk management mindset. So, as Jerry said, predicting the future is hard. Neither of us have a crystal ball. One of the great privileges of being dean of the Rotman School is I do get to hang around with some amazing global scholars. And some of my colleagues are doing some very interesting work on both culture and technology. And I thought what I would do is also sort of work in some of the insights of that research for where I think successful banks will go in the future. So that's my outline in a nutshell. If that's all you need, you can check your smartphones for the next 20 minutes. For everyone else, I'll try to add a little bit of content around that. So let me start with regulation. And I know you've already heard from Jerry and Greg, and I think what you're going to hear from me is roughly in the same vein. There's no question the global financial crisis has cast a huge shadow. These are storied names in finance that are either no longer around, have merged with another entity, or are effectively wards of the state. It's actually, in my mind, it was August 2007 that the crisis started. So we're getting very close to the 10-year anniversary. What's interesting is if you look at U.S. banks, the ones that are survived have actually recovered. Four out of 6 U.S.'s larger banks now have market capitalizations that exceed the book value of their assets. In contrast, European banks, you would not say the same thing. Very few European banks have market valuations that are above their book value. And if you look at the totality, you look at the stocks Europe 600 index of bank shares, it's down 2/3 from its peak 10 years ago. If you look across, really all international banks, whether they're American, European, Canadian, or Asian, the regulatory changes of the last decade have had probably an even more profound effect. The world's 30 systemic banks have boosted their common equity by over $1 trillion US. If you look at the, here's a chart showing SETI 1 in 2007 and in 2016, and leverage. And what you see is that, common Tier 1 capital ratios went from about 4% in 2007 to roughly 12% on average today. Leverage was 1 to 2% in 2007, up, leverage ratio up to sort of 4 to 6% today. And not surprisingly, ROEs have come down. These higher capital requirements, particularly on the trading book, combined with some restrictions on activities like Volcker Rule on what banks can do, together with ring fencing, have really altered the economics of different lines of business. And so this has precipitated a fair amount of change in the business models of many of the world's largest banks. I think overall, the consequences of the sweeping regulatory reform were needed, they were intended, and they were deliberate. And taken together, certainly my view is that new standards have made the system much safer. There have, however, been some unintended consequences, and I like Jerry's characterization. It was the more, I think, political elements that have probably had the biggest unintended consequences. I think Volcker Rule, for example, has created a pullback, together with higher capital requirements on the trading book, has created a pullback in market making that has reduced market liquidity. And so we are seeing an increased proclivity of markets to overreact to news. And the other thing is, it's very clear that some of the needed reforms or some of the needed outcomes could have been achieved at a far smaller regulatory burden. My guess is we're getting close to peak regulation. The consensus at the Basel Committee has frayed. This started at first. The Europeans were pushing back on adding new layers of regulation, and then since the election of President Trump, the wind has really shifted from a regulatory agenda to a deregulation agenda. And last week, I don't know if you went through this, Greg, but last week the U.S. Treasury issued its first in a series of reports to the President examining the U.S. financial system and outlining regulatory changes that could be undertaken to reduce the burden of regulation and increase support for credit growth, which the Trump administration clearly sees as a key foundation of economic growth. This first report, which just came out, focuses on deposit taking, and there's going to be a series that focus on other elements. I'm not going to go through the report in any detail, but first, when you read it, first of all, a couple things strike you. One is it's pretty critical of Dodd-Frank. Particularly the burden of regulation Dodd-Frank has placed on mid-sized and community banks. And it goes on to recommend a regulatory approach that is more tailored to the size and complexity of banks. So I think what you're going to see is a reduced regulatory burden on smaller and community banks. Interestingly, the report affirms the principle of the Volcker Rule, that proprietary trading should be limited, but then it goes on to recommend a number of ways to reduce the regulatory burden, probably raise the thresholds of what banks would be subject to Volcker, and reduce the complexity of compliance. Greg's better placed to comment on this on me. I think it's fair to say there's a fair amount of uncertainty as to where this all goes. But I think, we are seeing the pendulum is starting to sort of reach its peak and come back. I would say, though, that I think the pendulum is probably a couple years away from hitting its peak. And the reason for that is there's a bunch of stuff that's in the pipeline. It's been agreed, and it's still rolling out. I mean, here in Canada, just last Friday, Canada's Department of Finance issued new regulatory requirements for bail-in debt. And we are seeing supervision continue to intensify around a number of hot issues, cybersecurity, cross-selling, for example. So these things are already in train, so we've probably got a little ways to go. But when you look over the next 10 years, I don't expect regulatory change to be the defining theme that it was over the last decade. And I think the successful banks are probably going to be the ones. I don't think the pendulum's going to come too far back. I think it may come back a little bit, but I think you're going to see banks focusing more on how do we deal with regulation much more efficiently? How do we drive cost out of that, the big investments we've made, and how do we use some of the information we're getting from regulatory change to actually drive top-line performance and not simply deal with regulatory compliance. So let me shift gears to culture. Now, the original impetus of this focus on culture, which Jerry talked about, was very much the ethical failures that underpinned the financial crisis. There is compelling evidence that weak cultural foundations, ethical failures, were one cause of the financial crisis. There's no doubt that compensation schemes that delivered very large bonuses for short-term risk-taking encouraged people to take a lot of short-term risk, and that resulted in excessively risky positions. It also created some incentives for some individuals to, that created incentives for people to stretch the law, and some people clearly went well past the law. That created a very angry public response. The regulatory response at the Financial Stability Board was to introduce new rules around compensation, trying to align the horizon of compensation with the horizon of risk. But one of the things we've seen is that even as the financial crisis has faded into history, these conduct failures have persisted. And the number and the size of conduct failures in global banks, while the growth is diminishing, it continues to grow. And cumulative fines for the largest banks now exceed $320 billion. Conduct fines range from things like mis-selling, market manipulation, money laundering, terrorist financing. U.S. regulators have been very aggressive. I think European regulators, Asian regulators are kind of catching up. So you actually may see some more legs to this trend. For some banks, this is actually becoming a prudential issue. That's a pretty small number of banks, but certainly for the entire banking sector, conduct-related fines, client litigation, and redress have been a major operating cost. As loan PCLs have been coming down, fines have been going up, and that has been impacting ROEs on banks. So, not surprisingly, executives and board members at banks have been increasingly interested in culture and conduct. One thing you've seen from the crisis is that very few CEOs have survived revelations of a significant conduct failure. And I think that is appropriate. Culture has to start at the top with the selection of the CEO, and then it has to cascade down through the institution, supported by effective processes and reinforced by social norms. People do respond to incentives. Compensation is critical to that, and aligning compensation with the behaviors you want is an important element, but you can only align compensation with what you can measure. And for everything else, there's culture. Culture creates social norms that influence how people behave when nobody's looking. And for bank management, for boards, for supervisors, culture is increasingly seen as a valuable intangible asset that requires investment. Business schools are adjusting to this. We've certainly put more attention to courses on ethics. And a number of researchers, actually both at Rotman and Ivy, have been, these are often researchers in workplace psychology, organizational behavior. They've turned their attention to some questions about why do people cheat? How could you induce more moral decision making? And I have to say, if you read this research, there are some very surprising findings. And I'll just share a few here. The first one is that it turns out there might be something special about banks. I mean, it's not like banks are the only ones that have conduct failures. Look at, you know, SNC-Lavalin, Volkswagen, you know, they're not banks. But so is there anything special about banks? Well, it turns out there might be something special about banks. Now, researchers have known for some time that people are more likely to cheat when things involve money than when they involve other things. What's interesting is that more recently, some research by Professor Chen-Bo Zhang at Rotman has suggested that independent of whether things involve money or not, people tend to act more selfishly and are more likely to cheat when problems are reduced to a numerical comparison. So if it's very much a crunch the numbers kind of approach, and you can think of it in banking, you know, it's not about clients, it's just about counterparties. It's a highly numerical thing. It's sort of almost gamified. People's attention to the moral content of the decision diminishes, and they're more likely to act selfishly and cheat. And it actually appears that this is partly related to the way our brains work. We kind of have a numerical side of our brain and a sort of a moral and social side to our brain. And so when you're just using the numerical part of the brain, you're not thinking so much about the moral dimensions. The second thing, though, and obviously, you know, this presents a challenge for banks. I mean, banks, things do involve money, and they do involve a lot of numerical calculations. So, you know, if you're on the board of a bank, it's a pretty sobering thought. What is perhaps, though, equally surprising is that the research also shows that if you remind people of the moral and social dimensions of their decisions, that is actually fairly effective in overcoming the situational effect of money and calculations. So, for example, in the context of a bank, what you'd want to do is make sure you introduce in your process something that reminds your employee that, you know what, there's a real person at the other end of this transaction with a real family or a real small business, and that will sort of effectively re-invoke the social side of your brain. More generally, what this research highlights is that if you increase people's attention to your standards of integrity, your expectations for honesty, that will actually induce people to make more moral decisions. And again, this seems pretty surprising. I mean, don't people know what's right and wrong? Well, actually, people do know what's right and wrong. But the thing about humans is we are masters of rationalization. Everybody's doing it. My personal favorite, CEO makes 350 times what I make. Oh, it's only fair. Or, you know, this really isn't hurting anybody. So once you start rationalizing it, then, you know, you're kind of on that slippery slope. What the research shows, though, is if you can make the moral and the social dimensions of the decisions more explicit, then you will induce better behavior. And you know, I guess more generally what the research shows, and what actually I think you're seeing forward-looking banks do is, you know, leaders need to be clear about their values, and they need to talk about them, and their management teams need to talk about them. You need to increase people's attention to standards of honesty and integrity, as I just discussed. And probably the third one, and probably the most important one, is you got to walk the talk. You know, people really notice who gets hired, who gets a bigger bonus, who gets promoted. And the clear implication is that you got to make sure that in your hiring, in your compensation, in your promotion decisions, you reflect not only performance, but also the corporate values that you want to reinforce. It sounds pretty obvious, but it's actually a bit harder than you think. You know, when your star trader exceeded his limits and made a whole bunch of money, what are you going to do? You're going to look the other way, you're going to slap them on the wrist, or are you going to take a, you're going to fire them. You know, when your bank experiences a serious conduct failure, are you going to, are you going to cut the CEO's bonus in a material way, or are you just going to say, oh, too bad, so sad? You know, the message here is if you want to embed culture, you've got to walk the talk, and you've got to reinforce the values precisely when it's difficult. And as I said, I think forward-looking banks have embraced this. Where I think, though, we're starting to see a shift, and this is going to be more important going forward, is, banks embraced this initially to protect from the downside. They wanted to avoid big regulatory fines. They wanted to avoid scandals, reputational risk. I think more forward-looking banks, though, are starting to really see culture as a way of actually driving top-line performance. And in fact, there is some research that is showing that firms that promote integrity as a core value are more profitable. They are less unionized, they're more productive, and they're more attractive for future employees. Okay, let me conclude with disruptive technology. So, the last 10 years, financial institutions have been grappling with regulatory change, with conduct scandals. While they've been doing that, a whole new plethora of new players have entered financial services. And these are many relatively small fintech ventures. They're also big players: Google, Apple, Facebook. Very deep-pocketed institutions, all threatening to take some business away from large encumbered banks. And the new players have some advantages. They don't have any legacy assets. They don't have systems. They don't have conduct failures. And in most cases, they're actually operating outside the regulatory net. And as I indicated at the beginning, the span of this innovation really spans a wide range of elements of financial services. There's been a fairly wide sort of view on how disruptive this is going to be to financial services. I think one view is that, look, we're on the cusp of a big wave of financial innovation that is going to seriously disintermediate banks and really change the landscape. I think the other view is, look, innovation is not new. Banks have been through several waves of this, and they will work alongside these new players quite effectively. They'll buy them, they'll work with them, they'll partner with them. And I will say, in the last couple of years, we have seen a shift in the conversation. I think a couple of years ago, the conversation was, yeah, the fintechs were going to take over the world. The fintechs have now discovered, you know what, the banks have customers, and it's pretty hard to get to those customers unless you work with the banks. So you are seeing them work more together. One of the the other thing I think you're seeing, certainly at banks, is that the pace of technological change is having a big impact on strategy. You're seeing this at the management table. You're seeing this at the board table. And this is requiring new ways of doing business. So you're seeing banks open new innovative arms, special innovation labs. Scotia's got the digital factory. Almost every bank has something like that now. You're seeing them hire new people, more computer scientists, more data scientists, more people with design training, big data. It also requires some new skills in the C-suite and at the board table. Coming back to business schools, we're also investing more in teaching entrepreneurship and innovation. We're doing more research on technology and how that may affect banking and other businesses. And I thought I'd just say a few words as I close up about some research. 3 professors, Ajay Agrawal, Avi Goldberg, and Joshua Gans, are doing about one of the, I would say, large platform innovations that is affecting banking as well as others, artificial intelligence, particularly deep learning. there's a tremendous amount of hype around AI right now. And you can look back in history and see some other periods where we had big hype. And a good example would be 1995, World Wide Web arrives. All of a sudden, firms don't even need revenue to have valuations of $1 billion. The new economy has arrived. The old rules don't apply. And I think it's fair to say that everybody was talking about the new economy except for economists. Economists didn't really like the term. What economists focused on was, well, okay, we've got this new innovation. What is it doing? It is dramatically dropping the cost of digital communication. So we're going to see a lot more search and communication, and we're going to see activities that are complementary to that become more important. And indeed, that is, in many respects, what we saw. And this was really an extension of what we all know, Moore's Law. Every 18 months, the number of transistors doubles. And there's obviously a lot of science behind that, but economists like to simplify things. For an economist, it looks like this. It's a cost curve. What did semiconductors do? They dramatically dropped the cost of arithmetic. So the first things you saw when you dramatically what did you use it for? Well, it's first for, sending rockets up, digital orbits, spreadsheets are invented. And then actually what happens is some less obvious implications. So, semiconductors dramatically drop the cost of arithmetic. So at first it's kind of obvious applications of arithmetic, but then people started realizing, oh, cameras. We used to develop those as a chemical process. Oh, if arithmetic's really cheap, we could just digitalize this. So, now Kodak is bankrupt and we all take, thousands and thousands of more pictures than we ever took before. So when you look at AI, their thesis is we're going to see something like this. So for a computer scientist, that's what a neural network looks like. But for an economist, it looks like this. As I said, we like to simplify. So basically what their thesis is that what AI does is it dramatically drops the cost of prediction. And the implication of that is things that use a lot of prediction and input, it's going to be a lot cheaper. So, in a banking contest, what would you like to predict? Well, you'd like to know you'd like to be able to predict if a loan was going to default. You'd like to predict what customers want to buy. You'd like to predict if your employees or your counterparties are engaging in fraudulent activity. You'd certainly like to be able to predict money laundering, or at least who is at the highest risk of money laundering. You like to predict stock returns, portfolio returns. So, those are some pretty obvious applications of artificial intelligence. I think as time goes on, though, successful banks are going to figure out, more imaginative applications. And certainly, I think one of the sort of emerging things are more things like automated chat systems. The thing about AI is, unlike traditional, if-then-else computer programming, is you don't have to write the program like that. You just have to figure out it learns. So it could observe what financial advisors do many, many times, and then it could learn to replicate that. So you could have automated chat systems replacing real live advisors, for example. So their main idea is, okay, so what, if you're a bank and you're a management and you want to use this new technology, how should you think about it? Well, it's going to drop the cost of prediction. So, things that involve a lot of prediction, the input, that as an input is going to become much cheaper. That's going to change the value of other inputs. Coming back to the drop in the cost of arithmetic, when many of us were starting work, what happened? Lotus Notes is discovered, spreadsheets become the big thing. Well, accountants used to spend a lot of their time doing arithmetic. Accountants weren't wiped out, but actually you did see actually a reduction in the number of accountants. But the other thing you saw is that the salaries of accountants actually grew faster than the general salaries, because now with spreadsheets they could provide much more analytical content rather than just adding and subtracting numbers. And I think the implication here is that there's a lot of judgment around what questions to ask, how to use this prediction, and the value of that is going to go up. And banks that are able to shift their strategies to exploit that effectively are going to be the ones that are most successful. So this is just a slide. I just thought you'd be interested. Canada's actually a leader in artificial intelligence. These are three, Joshua Bengio, Jeff Hinton, and Richard Sutton are three computer science professors in Canada, and they are three of the top global gurus in artificial intelligence in Canada. That should be an advantage for Canadian banks. So let me just try and wrap up. Regulation's not going away. In fact, near term, I think it's still building. Banks are continuing to invest in their compliance functions. But over the next 10 years, I think you will see a shift in focus towards trying to maintain, basically satisfy regulatory requirements at less cost and translating some of the stuff that needs to be done to help in top-line performance. On culture, it's, the banks that are going to do well are the ones that succeed in marrying strong cultures of integrity, of customer focus, of risk management, with agility, with resilience, with adaptability, and with the ability to manage uncertainty. Banks are increasingly becoming technology companies. I think the successful banks are going to be the ones that are not distracted by the shiny objects, the glittering promise of new technologies. The successful banks are going to be the ones that can use technology to solve real consumer and business problems and can drive performance and efficiency in the middle and the back offices. And that's going to require new skills, new behaviors, and new business models. I look back over the last 10 years, I think the enduring lesson is that banking is a lot more than finance. And this isn't new, but the financial crisis, the stunning conduct failures, and the entry of new fintechs have reminded us that banking is as much about people, about technology, and about innovation as it is about finance. Banks have tremendous intellectual property in finance, and that is going to remain a core competency. But I think the future is going to demand a broader set of talents, and the most successful banks are going to be the ones that bring in that talent, that skill, these broader talent, skills, and behaviors to build successful institutions for the future. Thank you. So I have time for a few questions.
Okay, we have a few digital, and then we'll get some real questions. How do you visualize the banking industry in 5, 10, or 15 years in terms of barriers to entry, complexity, and interactions with other parts of the financial system, given these three forces?
Yeah, that's a tough question. As I mentioned, a lot of the fintech innovators are operating outside of the regulatory framework, and that's actually fine as long as they're relatively small. But a lot of the things they do, so they would never say they take deposits, for example, but they will take prepayments so that you can make a payment in the future. Well, I don't know about you, but I pretty much keep money in my checking account in order to make payments. So I think as what you're going to see is as some of these fintechs become more important, they aren't going to call what they do. They're going to try, use different words, but at a certain point, I think regulators are going to have to say, well, if it looks like a duck, quacks like a duck, it is a duck, and there's going to have to be some comparability in regulation. Now, I think the real trick, the real challenge, I think, for regulators is going to be to not stifle that innovation, because we really want that innovation. 7 or 8 years ago, innovation was completely a dirty word in finance. I mean, a lot of the innovations that in securitization and structured products turned out to be pretty socially destructive. But we have to move past that. And so, I think hopefully we can get a regulatory structure where there are some size limits, some safe zones that allow a certain amount of innovation. And then if you reach a certain critical size, that and if you're doing things that involve, leverage, maturity mismatch, those types of things that we know have certain dangers, that you come under more comparable regulation.
Okay. So Who's responsible for the bank's culture? Is it the board that can impose it on the firm? Is it management? And what's the role that regulators are going to play in this?
Good question. So the board plays a critically important role in the sense that the board, the board's biggest responsibility is to hire the CEO and to fire the CEO if needed. And as I said, culture really starts with the top, and then it's got to cascade down. And if the board is not happy with the culture of the CEO and really the most senior team, the board has a real responsibility to act. The management team has a real responsibility to drive that culture down. And actually, I think that's the toughest part of this. I think is getting the culture down from the top, right down to the teller, the advisor on the front line, and making it real to them. Banks are I think forward-looking banks are experimenting with different ways of doing that. It starts with things like surveys, but it gets into things like, using sort of fun technology, having a culture jam or something, things like that. You also have to realize that, a bank like Scotiabank, for example, operates in very different geographies. Different words mean different things. There's different cultural norms. There's got to be a common core to your values that are immutable to, doesn't matter what geography, but at the same time, you may have to adapt it a little bit to different geographies. Coming back to regulators, I think it would be really unfortunate. I think that the risk is if the boards and management don't do the job on culture, then regulators will. And I think that would be a very unfortunate outcome. I think regulators do have some responsibility to have a sense of the culture, but I really hope we don't get it into a world where regulators are sort of legislating the culture of financial institutions.
Okay. Over there, in the center of the room.
This may seem like a simplistic question, but as a board member,
Those are usually the hard ones.
yeah, like how do you, what does success look like? Is success survival or is success picking up market share? Like this future state that we're talking about, the successful banks. What, can you give us some meat on the bone as to what you're looking for as a board member 5-10 years from now?
I think one of the challenges of being a board member is that most people who are board members are used to running things. And so you have to resist that. Our job is not to run the bank. I think the key, I would say certainly as a board member, two key things I look for is, first of all, what is the strategy? Does the strategy make sense? But it's fundamentally management under the leadership of the CEO to come up with a strategy and bring it to the board, and then take the board's feedback into account as you refine that strategy. And then success, really looks like I just go back to that strategy. I mean, are they executing against the strategy? Is the strategy working? There's a few things that can happen. One is you execute against the strategy, but you don't get the returns, you don't get the growth, you don't get the performance that you expected. So there's something wrong with the strategy, or you're failing to execute against the strategy. Strategy's proving tougher to do than you thought, or the market conditions have changed and that strategy needs to be updated. So I don't think you're not the CEO as a board member. It's not for you to define what the future is going to look like. It's really to provide some oversight and then hold to account that you're actually executing against that.
Yeah. So here's the tough one as well. Okay, so looked at from a global perspective, how do you see how are the Canadian banks doing in terms of meeting your standards for culture and technology? What kind of grade would you give them?
That one is a tough one. On culture, actually, I would say, one of the questions earlier on was, why did Canadian banks survive the financial crisis better than most? And I have to say, certainly my previous roles, right after the crisis, as I was, dealing with a lot of other countries, that was probably the question I got the most from other countries. And I think culture was part of the answer. I think, yes, regulation, and particularly the cap on leverage, kept Canadian banks away from a lot of subprime, because the thing about subprime was, in order to make money on it, you had to do a lot of it, because actually the spread pickup wasn't that big. But if you had a leverage cap, it just didn't make you run up, you use all your leverage room against what looked like a pretty low risk asset. So it wasn't really a very good investment for Canadian banks. So I think regulation was important, but I also think culture was a factor. I think Canadian banks, it's interesting, you'll probably remember the IMF came to see us in 2006 and wrote this scathing report of the financial sector in Canada. We were a bunch of Luddites. We weren't adopting this dynamic, innovative world of securitization that the US was. Like, we were going to stunt the growth of our economy. I really enjoyed the visit a couple years later when, we were now the IMF's poster child for sound. What was the question again? I was enjoying that moment so much.
How would you rate how the Canadian banks are doing?
So on culture, I do think actually, we've done pretty well, and I think we continue to do actually pretty well. I do think, though, that you can't be complacent about it, and I think there needs to be more of a shift from cultures just to protect yourself from bad things happening to cultures about driving performance. I think a more performance culture. I think Canadian banks are doing pretty well on customer focus and on culture of integrity. I think a more performance culture is something that I think you're seeing at the top. I think you're seeing it at the bottom. I think in the middle of a lot of banks, it's tough to get change. And the other part of the question
it was like, what's the score on technology?
Oh, technology
compared to global banks?
Right. I would say that Canadian banks, it's hard, we have a lot of banks, a little hard to generalize, but on average, I would say we lagged a bit. We've got a oligopolistic market structure. We've had very stable, very good returns. I think the idea that we needed to be sort of at the cutting edge of technology wasn't front and center. I would say that I think Canadian banks are really catching up. Certainly, I see very upfront what Scotia's been doing. The digital factory. It really is quite something. And you go there, and it's not just the investment in technology, but it's the investment in people. I mean, first of all, you walk in, everybody's wearing jeans and a t-shirt. You go, is this a bank? Doesn't look anything like a bank. So I do think they're catching up, and I think one thing that so I think when we started down this track, we thought, oh, this catch-up is going to be so hard because there are all these legacy systems, and there's so many big investments. And I don't want to diminish the issues with legacy systems, but one of the beauties of a lot of the technological innovations, cloud computing, for example, means that you can actually move pretty quickly. And you're not as tied as you used to be to these huge transformations.